let's just cut to the chase, okay? We really need to have a serious, no-nonsense conversation today. Welcome to this explainer. I'm going to talk to you like an elder brother, giving you a much-needed reality check on the financial markets. Forget the fluff. We're here to decode the hidden options trap once and for all.
So let's start with the ultimate beginner frustration. Look, if you spend any time on social media, you've seen the endless screenshots of massive trading profits, right? They make options trading look like this magical shortcut to infinite wealth. But the reality? Yeah, it's very different. Just imagine this for a second. You analyze the market, you buy a call option on the Nifty because you are absolutely certain the market's going up, and guess what? You nail it. You are 100% correct. The Nifty goes up. But then you look at your screen and your option premium has mysteriously crashed. You are literally losing money even though your market direction was dead on. I mean, how is that mathematically possible? It feels totally rigged, doesn't it? Well, I promise you it's not rigged. It's just that most beginners think options only move because of the stock or index price. But the truth is, you're playing a multi-dimensional game while only staring at a one-dimensional board.
Okay, let's really dive into this because this is exactly where the blindfold comes off. Option prices are not just tied to the underlying stock price, not even close. They're actually controlled by a set of hidden, incredibly powerful forces. We're talking about time decay, volatility crush, and a complex series of mathematical variables known as the Greeks. These are the gears turning under the hood of the market. And honestly, if you're trying to trade options without understanding these forces, you aren't trading. You are just blindly hoping. And let's be real, hope is a terrible financial strategy. All right, before we get into the really complex mechanics, let's quickly map out the playing field just so we're all entirely on the same page. When you look at an option chain, you're going to see three main categories: ATM, ITM, and OTM. Let's just use the Nifty as a simple example. If the Nifty is currently trading right at 22,000, then the 22,000 strike price is at the money, or ATM. It's right on target. Now, if you're looking at a call option, a strike below the current price, say 21,800, is in the money, or ITM. Think of an ITM option like a treasure chest. It actually already has inherent value inside it. On the completely opposite side, a strike above the current price, like 22,500, is out of the money, or OTM. It's currently not profitable at all, and it holds zero intrinsic value. It's purely based on the hope that the market moves your way before time runs out.
Now, let's talk about the 5 distinct forces that are actively pulling at your premium. Understanding this completely redefines what you should be watching on your screen. You see, beginners, they only stare at the underlying price movement. But professional traders, they are monitoring all 5 of these factors simultaneously. Sure, your option premium is constantly reacting to price movement, but it's also shrinking based on the time left to expiry. It's swinging wildly based on market volatility, shifting with demand and supply, and being actively calculated by the option Greeks. Listen to me on this one. If you ignore 4 of these 5 factors, you are basically walking into the market completely blind.
So let's meet the first Greek, delta. Think of delta in very, very simple terms. It measures exactly how much your option premium is expected to move if the underlying index, like the Nifty, moves by just one single point. Call options have a positive delta, and put options have a negative delta. Now here's the absolute biggest trap beginners fall into. Out-of-the-money options are cheap, right? So beginners buy them in huge bulk. But OTM options have a very low delta. This means even if the market moves 50 points in your direction, your cheap little option might only move 5 points. You are basically buying cheap lottery tickets hoping for a miracle move that almost never comes. Meanwhile, the professionals, they're trading in-the-money options with a much higher delta that actually move almost perfectly in sync with the market.
And this brilliantly illustrates our next concept. If delta is the speed at which your premium moves, gamma is the acceleration. Gamma measures how fast your delta is changing. Imagine you're in a car. Delta is your speedometer reading 60 miles per hour. But gamma is you literally slamming your foot on the gas pedal. As an option gets closer to being at the money, and especially as it gets closer to expiry, gamma absolutely spikes. This makes delta change incredibly rapidly, which causes sudden, violent swings in premium prices. This right here is exactly why beginners get trapped in those wild price swings near expiry. They just don't realize gamma has taken the wheel.
Next up is the ultimate villain for the option buyer, Theta. Theta represents time decay. It is the silent, invisible force that reaches right into your pocket and takes money out every single day. Yes, even over the weekends. You see, unlike buying a stock that you can basically hold forever, options have an expiration date. Because of this, time is working completely against you. If you buy an option and the market just chops around sideways, doing absolutely nothing, you are still going to lose money. Why? Because Theta is slowly, continuously bleeding your premium dry.
Seriously, this is exactly how you need to view options. They are wasting assets. Just picture an option contract like a block of ice, sitting out in the blazing hot sun. From the very second you buy it, it begins to melt. Every single day that passes reduces the option's value. And remember those cheap, out-of-the-money options we talked about earlier? Yeah, they melt the absolute fastest. If the market doesn't make a massive, explosive move in your direction really quickly, that ice cube is going to turn into a puddle and your option will expire completely worthless. Honestly, this one single concept is a major reason why so many beginners just completely wipe out their accounts.
All right, let's see how all this builds with our next greet, Vega. Vega measures the impact of implied volatility, or IV, on your option premium. So what exactly is implied volatility? Well, simply put, it's the market's expectation of future fear, uncertainty, and massive price swings. When people are scared or just really unsure about what the market's going to do next, IV rises. And when IV rises, option premiums get incredibly expensive. Vega is basically the metric that tells you just how much that premium is going to inflate for every 1% jump in volatility.
So what actually causes all this fear and uncertainty? Specific events. Just think about budget day, election results, major RBI policy announcements, or even massive corporate earnings reports. In the days leading up to these big events, nobody actually knows what's going to happen. Uncertainty is at its absolute peak. And because of this, implied volatility skyrockets. Just like a balloon inflating, premiums expand to their absolute peak, most expensive prices. Beginners will look at the market, expect a huge move, and eagerly buy options, totally completely unaware that they are buying at the absolute worst possible time just because of Vega.
And here comes the really painful reality check. What do you think happens the minute the news is actually announced? The event passes. The uncertainty vanishes. The fear is just gone. And even if the market shoots in the exact direction you predicted, the implied volatility drops like a stone. This is what we call IV crush. The premium of the option collapses so incredibly fast because of that dropping volatility that it completely wipes out any gains you would have made from the actual price movement. This, my friends, is the exact answer to the question we asked at the very beginning of this explainer. You got the direction right, but IV crush completely destroyed your premium.
Okay, let's shift gears slightly and talk about a metric that isn't technically a Greek, but it is just as crucial. Open interest, or OI. OI simply represents the total number of active, outstanding contracts that are currently held by market participants. It's essentially telling you where the big money is placing their bets. Generally speaking, in the options world, a high call open interest often indicates a strong resistance zone, basically a ceiling where the market might really struggle to break through. Conversely, a high put open interest often acts as a support zone, a floor where the market is likely to bounce.
But listen to me, the crucial point is this. Open interest is a clue. It is not a crystal ball. As your elder brother in the space, I have to give you a stern warning here. Do not ever blindly trust OI to make your trading decisions. The market is highly dynamic, institutional option writers have massive capital, and they can shift their positions, close contracts, and create entirely new resistance levels incredibly quickly. OI is literally just one single piece of a very large puzzle. If you use it as your only indicator, I guarantee you'll eventually get trapped when the big players suddenly change their minds.
Which brings us to the single most dangerous day of the week for any beginner, expiry day. When you compare normal trading days to expiry trading, it's basically like comparing a casual bicycle ride in the park to strapping yourself into a massive roller coaster that doesn't have any brakes. On normal days, the pace is steady, but on expiry day, the mechanics change completely. Remember Theta, our melting ice cube? Well, on expiry day, Theta decay becomes incredibly aggressive, wiping out premium hour by hour. And Gamma? Gamma spikes violently, causing wild, erratic premium movements from tiny little index changes. Beginners get so addicted to this fast-moving, cheap premium environment, but these exact mechanics make it incredibly dangerous and highly likely to wipe out your capital in a flash.
So when we pull back and look at the harsh reality, the reasons beginners consistently lose money become very, very clear. They completely ignore the Greeks. They trade based on emotion, dopamine hits, and a complete lack of discipline rather than actual probability. They over-leverage their small capital, they chase that fast money they see flaunted on social media, and they continually buy cheap out-of-the-money options hoping for a lottery win. Trading derivatives is not easy money, guys. It requires intense risk management and deep psychological control. And just as a quick reminder, everything we've discussed today is purely for your educational awareness so you understand these mechanics. It is absolutely not financial advice to start trading.
I really want to leave you with this incredibly powerful thought.
First survive in markets, then think about profits. Too many beginners focus only on the potential rewards while completely blinding themselves to the hidden risks we just uncovered today. Your absolute first goal has to be capital preservation. You have to build discipline, patience, and a deep, deep understanding of how money actually works in these systems before you ever risk a single rupee. Next time, we're going to take this foundation we built today and dive even deeper into reading the option chain itself, uncovering even more clues that the market leaves behind. But until then, focus on learning, prioritize your risk management, and please don't fall for the traps. See you in the next explainer.